I lost everything in 1929. Not just money, though $100 million in today's dollars is certainly substantial, but my reputation, my confidence, and nearly my sanity. I want you to understand exactly how Wall Street's once greatest trader crashed spectacularly, because the lessons I paid for with my financial life can save yours. This isn't theory. It's the bloodied wisdom I earned through the most devastating market collapse in modern history. In the next 45 minutes, I'll reveal the exact psychological traps that destroyed me during the Great Crash. You'll learn the precise warning signs I ignored, the leverage mistakes I made, and the emotional demons that clouded my legendary market vision. These patterns repeat in every market cycle, 2008, 2020, and whatever crash awaits you next. I was called the Boy Plunger and the Great Bear of Wall Street. By 1929, I had already made and lost multiple fortunes. My short positions during the 1907 panic earned me $1 million in a single day when I was just 30 years old. I pioneered trading techniques still used today. I understood market psychology better than anyone alive, yet I still lost everything. When I entered my office on that fateful October morning in 1929, the ticker tape was already spewing disaster. Market positions I believed impregnable were disintegrating. My hands trembled as I watched millions evaporate hourly. The cold sweat on my neck matched the ice forming in my stomach. I had seen crashes before, had profited enormously from them, but this time was different. This time I was caught on the wrong side. What makes a master trader self-destruct? The answer isn't merely academic. It's essential survival knowledge. When you understand how I ignored my own trading rules, how I betrayed my own system, you'll recognize these same destructive patterns in your own trading before they destroy you. I developed a trading methodology that made me one of the richest men in America, then abandoned those very principles at the worst possible moment. The psychological autopsy of my greatest failure will show you exactly where your own trading mind is vulnerable. By the end of our time together, you'll understand the 3 fatal errors that destroyed my fortune, the 5 warning signs I willfully ignored, and the exact psychological weaknesses that can transform even market legends into cautionary tales. More importantly, you'll learn the specific safeguards I developed afterward, techniques that would have preserved my wealth had I implemented them sooner. The market doesn't forgive and it doesn't forget, but it does repeat patterns. Let me show you exactly how Wall Street's greatest trader lost everything, so you never have to. I first recognized the pattern of boom and bust during my early days on Wall Street. From 1900 to 1929, I witnessed the market's cyclical nature with a clarity few traders ever develop. The pattern was unmistakable to me. Euphoria, followed by excess, then collapse. I made my first million by 1907, precisely because I understood what others couldn't see. Markets move in predictable waves if you have the patience to observe them. The 1907 panic taught me an invaluable lesson. While most were blindly riding the bull market, I noticed the credit markets tightening. I went short against J.P. Morgan himself. When the market collapsed in October, I walked away with $3 million, about $86 million in today's money. Not because I was smarter, but because I respected the pattern while others ignored it. I've always studied market history obsessively. The post-World War I boom showed me the same signals I'd seen before. By 1921, I recognized the early stages of what would become the Roaring Twenties bull market. I went long when others feared another recession, understanding that the cycle was turning upward again. The industrial expansion was creating genuine value, and I positioned myself accordingly. But by 1927, I noticed troubling signs: excessive margin trading, wild speculation in Florida real estate, and ordinary people pouring savings into stocks they didn't understand. I'd seen this movie before. The public was buying stocks at any price, convinced they could only go up. This violated my core principle: never follow the crowd at market extremes. In 1929, I began building my short positions methodically. My brokers thought I was insane. The Dow had tripled in less than 7 years, but I'd learned to trust my analysis of the cycle, not public sentiment. When the crash came in October 1929, I made approximately $100 million in today's dollars, my greatest trade ever. What few understand about that period is that the real devastation came not from the initial crash, but from the false recoveries that followed. I made fortunes shorting each of these rallies from 1930 to 1932, recognizing them as what I called suckers' rallies, brief upward movements in an established downtrend. The pattern remains unchanged today. The same human emotions, greed and fear, drive markets in the same cyclical pattern I traded a century ago. I've always maintained that markets don't create new patterns. They simply repeat old ones with different actors. My success came from recognizing this fundamental truth when others were blinded by the circumstances of their particular moment in history. I've made and lost several fortunes throughout my career. Why? Because trading isn't about mathematical formulas or secret indicators. It's about psychology. In 1930, I learned this lesson the hard way, losing millions when I failed to follow my own rules. The market punishes psychological weakness with devastating efficiency. Let me share the psychological traps that have cost me millions over my career. First, there's what I call revenge trading. After taking a loss, I would often double down, trying to get even with the market. In 1907, I lost $50,000 on a cotton trade and immediately jumped back in with twice the position size. I was angry, emotional, and determined to prove myself right. The result? I lost another $100,000. The market doesn't care about your ego or your need for vindication. The second trap is confirmation bias. I've repeatedly fallen into this one myself. In 1929, I correctly predicted the crash and made $100 million, about $1.5 billion in today's money. This success made me dangerously overconfident. I started seeking out only information that confirmed my bearish outlook, ignoring clear signs of a temporary recovery. When I finally recognized my error, it was too late. I had given back millions in profits. The third psychological trap is fear of missing out, what you might call FOMO today. I've watched countless traders, myself included, jump into positions simply because the market was moving and they couldn't bear to be left behind. In 1925, I abandoned my own analysis and bought stocks simply because everyone else was making money. I knew better, but the psychological pull was too strong. That mistake cost me $2 million. Fourth is the inability to sit still. Most traders don't understand that doing nothing is often the most profitable strategy. During quiet markets in 1916, I forced trades out of boredom and impatience, bleeding my account with 1,000 small cuts. The greatest stock operator is not the one who trades most frequently, but the one who waits patiently for the perfect setup. The final trap is perhaps the deadliest: failure to cut losses quickly. I've repeatedly watched small, manageable losses transform into account-destroying disasters because of psychological attachment to being right. In 1930, I held on to positions far too long, turning what should have been a 10% drawdown into near bankruptcy. These psychological traps have one thing in common: They all stem from emotional, rather than rational, decision-making. I developed my trading rules specifically to protect me from my own psychology. Without strict rules, I'm just another emotional trader destined for ruin. The market will find your psychological weaknesses and exploit them mercilessly. The market has no memory, no emotion, and no obligation to make you wealthy. I learned this the hard way during the crash of 1929, when I made $100 million shorting the market, only to lose it all by 1932. These devastating losses taught me 3 fundamental rules that saved my trading career. Rule number 1: the trend is your friend until the end when it bends. During 1930-1932, I watched as desperate investors kept buying stocks on the way down, convinced the market would recover. They were fighting the trend. I made the same mistake myself, getting bullish too early and watching my fortune evaporate. The market doesn't care about your hopes or your beliefs in a recovery. It only responds to supply and demand. I developed a simple method to identify the primary trend. I track the market's behavior at key price levels. When stocks fail to make new highs and begin making lower lows, the primary trend has changed. No amount of wishful thinking can change this reality. During those Depression years, I watched seemingly strong stocks like U.S. Steel collapse from $260 to $20. The trend was down, and fighting it was financial suicide. Rule number 2: never average down on a losing position. This destroyed more trading accounts in 1930-1932 than perhaps any other mistake. I watched as formerly wealthy men kept buying more shares as prices fell, believing they were getting bargains. The market doesn't care about your average price. It only cares about supply and demand forces. When I violated this rule myself, I always regretted it. Adding to losers feels right emotionally. You're lowering your average cost basis, but psychologically, you're doubling down on a mistake. I've never seen a great trader consistently average down and succeed long-term. Cut losses quickly instead. Rule number 3: markets are never wrong. Opinions often are. In 1931, I had a strong opinion that certain railroad stocks were undervalued. The market disagreed. Guess who was right? The market. My opinion cost me millions because I refused to accept what the price action was telling me. Your opinion means nothing to the market. My opinion means nothing. Only price action matters. When I finally learned to subordinate my opinions to the market's message, I began to trade profitably again. I stopped predicting and started following. These 3 rules saved what remained of my trading career after the devastating losses of 1930-1932. The market had humbled me completely. I had to rebuild from scratch, not with a new strategy, but with proper respect for market fundamentals that never change. The market doesn't care about your theories. It only responds to buying and selling pressure. Remember that, and you might survive where I nearly didn't. Rule number 3: cut losses quickly. This principle cost me fortunes to learn, yet saved me millions more. When I first started trading, I'd stubbornly hold losing positions, praying for recovery. The market taught me better through brutal lessons that scarred my account and my pride. In 1929, I sensed the market turning. While others were still buying, I was already positioning short. I'd learned to recognize the signs: excessive speculation, margin debt at record levels, and wild optimism despite deteriorating fundamentals. The pattern was unmistakable to me after decades of observation. But here's what most don't understand about my success in 29. It wasn't just that I bet against the market. It was that I had cut my losses ruthlessly in previous attempts. I'd made 3 earlier attempts to short the market that year, taking small losses each time when the position moved against me. Had I stubbornly held any of those losing positions, I would have been financially and psychologically devastated when the real opportunity arrived. Let me be crystal clear. The ability to take a loss promptly is the first test of a successful trader. I watched countless brilliant men destroy themselves because they couldn't admit being wrong. Their egos wouldn't allow it. They'd average down, doubling their risk on a bad position, turning manageable losses into catastrophic ones. I developed a mechanical rule that saved me countless times. When a stock moves 10% against my position, I exit. No questions, no hesitation, no hope. This isn't about being right or wrong, it's about survival. The market doesn't reward stubbornness, it rewards adaptability. During the 1907 panic, I ignored this rule and it nearly ruined me. I was short Union Pacific, convinced it would collapse. When it rallied against me, my pride kept me in the trade. That single mistake cost me everything I had built. I had to start again from nothing. By 1929, I never violated this principle. When I shorted the market that October, I placed my stops and honored them religiously. When the crash finally came, I was positioned perfectly because I had preserved my capital through disciplined loss-cutting earlier. Remember this, markets can remain irrational longer than you can remain solvent. No matter how confident you are in a position, always define your maximum acceptable loss before entering. Then honor that limit without exception. This isn't about fear, it's about professional risk management. The greatest traders aren't those who never lose, they're those who control their losses. Rule number 4, wait for confirmation. This might be the hardest lesson I ever learned, and it cost me millions before I finally understood it. In my suite at the Plaza Hotel in 1932, I was reviewing my trading journal when the pattern became undeniable. Every major loss I'd suffered came from the same mistake, jumping into positions before the market confirmed my thesis. Let me explain what confirmation really means. It's not just seeing a pattern forming. It's seeing the market prove the pattern is valid through actual price action. When I was younger, I'd spot what looked like a breakout and immediately go all in. Pure gambling. The mature trader I became learned to wait for that crucial second signal. Here's my exact process. When I identify a potential move, I place only a small pilot position, no more than 10% of what I ultimately intend to trade. Then I wait, I watch. I look for the market to confirm my hypothesis through continued movement in my anticipated direction. Only after this confirmation do I add to my position. This method saved me during the crash of '29. While others were blindly buying the dips, I waited for confirmation of the downtrend before committing serious capital to my short positions. The market doesn't reward impatience, it punishes it ruthlessly. In 1907, I lost everything because I couldn't wait for confirmation. By 1929, I'd learned to let the market show its hand first. Think of it like tracking an animal. You don't run after the first footprint you see. You look for a trail, confirm the direction, and only then do you follow with confidence. The discipline of waiting for confirmation also protects you from your own biases. We all want to be right immediately. We all feel the urge to act. Controlling that urge separates professionals from amateurs. I developed a specific 2-day rule for breakouts. After a stock breaks through resistance, I wait 2 full trading days before establishing a major position. If the breakout is genuine, I'll still catch 80% of the move. If it's false, I've protected my capital. Remember this, the market will always be there. The opportunities never stop coming. Missing one trade by being patient costs you nothing. Jumping into a false move can cost you everything. When I sit in a hotel room reviewing my trades, the winners almost always share this characteristic. I waited for confirmation. The losers show the opposite. I acted on hope rather than evidence. Patience isn't just a virtue in trading. It's the difference between survival and destruction. Rule number 5 is perhaps the most critical principle I've developed in my decades on Wall Street. Always trade with the primary trend. I learned this lesson the hard way at the Chicago Commodities Exchange in 1934, after I'd already made and lost several fortunes. When you fight the primary trend, you're swimming against a powerful current that will eventually exhaust and drown you. I remember standing on the exchange floor that day in '34, watching traders frantically trying to short wheat when the market was clearly in a bullish primary trend. I'd made this mistake myself in 1915, fighting an uptrend and losing nearly $250,000, equivalent to millions today. I never repeated that error. Let me be crystal clear about what I mean by primary trend. This isn't about day-to-day fluctuations or even weekly movements. I'm talking about the major directional flow that typically lasts for months or years. In 1934, I observed the agricultural markets entering a multi-year recovery phase after the Depression bottoms. Those who recognized this early made fortunes. Those who fought it were financially destroyed. Here's my method for identifying the primary trend. First, I examine the weekly and monthly charts, not the daily noise that distracts most traders. Second, I look for higher highs and higher lows in bull markets, or lower highs and lower lows in bear markets. Third, I confirm with volume. Increasing volume in the direction of the trend validates its strength. In Chicago, I noticed wheat prices establishing a series of higher lows over 6 months with steadily increasing volume. This wasn't random. It was the market telling me something significant. While others debated daily price movements, I positioned myself for the primary bullish trend and watched my account grow substantially. The psychological challenge is that trading with the trend often feels wrong. When a bull market has already risen substantially, your instinct says it's too late to buy. When a bear market has already fallen dramatically, your instinct says it's too late to sell. These instincts are almost always wrong. During the 1929 crash, I made $100 million in today's dollars by identifying and trading with the primary downtrend. I didn't predict the crash. I simply recognized the primary trend had changed and aligned my positions accordingly. Remember this: the primary trend is like gravity. You can fight it temporarily, but its force will eventually prevail. I've learned that aligning with this force rather than battling against it is the difference between trading success and failure. When you identify the primary trend correctly, even mediocre trade entries can become highly profitable. When you fight the trend, even brilliant entries will likely end in losses. Position sizing is the difference between survival and destruction. I learned this lesson in 1936 after decades of both spectacular victories and devastating losses. When I began trading, I would risk 50% of my capital on a single position. The market taught me the folly of this approach through painful lessons that nearly destroyed me multiple times. I developed a strict rule: never risk more than 10% of your trading capital on any single position. This single principle saved me during the 1929 crash, when others were wiped out completely. While they were jumping from windows, I was calculating my next move with a clear head because my position sizes were controlled. Let me explain exactly how I implement this. First, I determine my total trading capital. let's say $100,000. Next, I decide the maximum I'm willing to lose on any trade, 10% or $10,000 in this example. Then I calculate my entry point and stop-loss level based on market conditions. If I'm buying U.S. steel at $50 with a stop at $45, that's a $5 per share risk. To limit my total risk to $10,000, I can purchase a maximum of 2,000 shares, 10,000 to learn 5. This mathematical approach removes emotion from the equation. The beauty of position sizing is that it allows you to be wrong repeatedly without destroying your capital. I've been wrong on 7 trades in a row and still preserved enough capital to make the 8th trade, the one that delivered extraordinary profits. In 1936, I watched a brilliant young trader destroy a $500,000 account in 3 weeks. His analysis was actually correct, but his position size was so large that when the market temporarily moved against him, he couldn't withstand the drawdown. He was forced to liquidate at the worst possible moment, just before the market turned in his favor. Meanwhile, I took the same trade, but sized it appropriately. When the market dipped, I remained calm, knowing my potential loss was limited. When the market eventually turned, I captured the full move while he watched from the sidelines, financially ruined. Remember this: the market will test your conviction through adverse price movement. Your analysis might be perfect, but without proper position sizing, you won't survive long enough to be proven right. I've made millions in the market, but I've also lost millions. The difference between my survival and others' destruction wasn't intelligence or market knowledge. It was position sizing. The market doesn't forgive those who bet too heavily. No matter how brilliant their analysis, the most important rule I've lived by: cut your losses quickly. When I began trading in the bucket shops of Boston as a teenager, I made the same mistake countless times. I'd watch a position move against me and think, it'll come back. Those 3 words have destroyed more trading accounts than any market crash. In 1934, Wall Street taught me this lesson in the harshest way possible. I had built a substantial short position in wheat, convinced the market would collapse. The fundamentals supported my thesis. Drought conditions were improving, and supply reports indicated a bumper crop. But the market disagreed. Instead of accepting a small loss when wheat prices first ticked up against my position, I doubled down. The market is wrong, I told myself. It must come down. I added to my shorts as prices rose, averaging up my cost basis, pure poison to a trading account. By the time I finally capitulated, my loss was 20 times what it would have been had I simply cut it at the first sign of trouble. That single error cost me over $100,000, equivalent to nearly $2 million today. Here's what I learned. The market doesn't care about your opinion. It doesn't care about your research. It doesn't care what you paid for a position. The only thing that matters is price action. When I'm wrong, I exit. Period. No debate, no rationalization, no hoping. I've programmed myself to react to the evidence in front of me, not the narrative in my head. This discipline saved me during the panic of 1907, when I quickly reversed my position from short to long as soon as I saw the market wasn't responding to negative news as expected. I've developed a mechanical rule. Any position that moves 10% against my entry point gets closed. No questions asked. This isn't about being right or wrong. It's about survival. Think of trading capital as oxygen underwater. Each loss is a breath expelled. Small, controlled exhalations are necessary, but hold your breath too long or exhale too much at once, and you drown. The most dangerous words in trading are just a bit longer. I've watched brilliant men destroy themselves with this delusion. They couldn't accept a small loss, so they took a catastrophic one. Remember this: your first loss is your best loss. Cut it quickly, preserve capital, and live to trade another day. I've made and lost several fortunes in my career, but whenever I strictly followed this rule, my account grew. Whenever I violated it, disaster followed. This isn't theory. This is the difference between survival and destruction in the markets. Rule 6 is one I learned the hard way in 1935. Trade only liquid markets. Sitting in my New York trading office, I watched countless traders get slaughtered because they ignored this fundamental principle. Liquidity isn't just a technical term. It's your escape hatch when things go wrong. I've been trapped in illiquid positions more times than I care to admit. In 1907, I made a killing shorting Union Pacific during the panic, but in several smaller railroad stocks, I couldn't exit my positions when I needed to. The bid-ask spreads widened to canyons. My paper profits evaporated because there simply weren't enough buyers when I needed to sell. Liquidity means you can enter and exit a position without moving the market significantly against you. I always ask myself, if I need to exit this entire position in one day, can I do it without taking a 10% haircut? If the answer is no, I walk away, no matter how attractive the opportunity seems. During the 1929 crash, I made millions because I focused on the most liquid stocks on the exchange. While other traders were stuck in positions they couldn't unload, I moved in and out of RCA, U.S. Steel, and other blue chips with relative ease, even on the worst days of the panic. The mathematics are simple. In liquid markets, the distance between the bid and ask is narrow. Your transaction costs are lower. Your ability to execute at your desired price is higher. Your risk of getting trapped is minimal. I've developed a practical test for liquidity. If the daily trading volume isn't at least 10 times what I plan to trade, I don't touch it. Period. This rule has saved me countless times when market sentiment shifted suddenly. Remember the mining stock boom of 1933? I watched traders pile into stocks that traded only a few hundred shares a day. When those stocks collapsed, many couldn't sell at any price. Meanwhile, I traded gold mining shares that had deep markets, homestake mining being my favorite, and could adjust my positions whenever my analysis changed. Liquidity also gives you psychological freedom. When you know you can exit, you make clearer decisions. You're not held hostage by your positions. I sleep better knowing I can liquidate everything by tomorrow's close if necessary. Never forget, the market doesn't owe you an exit strategy. That's your responsibility. And the first step is trading only in markets liquid enough to let you escape when your analysis proves wrong, or when you're right and it's time to collect your profits. Rule number 7 is perhaps the most vital of all my trading principles. Preserve capital at all costs. I learned this lesson through rivers of my own blood spilled on Wall Street. By 1936, while relaxing at my Palm Beach estate, I had already made and lost several fortunes. Each cycle taught me the same brutal truth. Without capital, you're out of the game entirely. I remember sitting on my veranda, watching the Atlantic waves crash against the shore. The rhythm reminded me of market cycles, predictable yet violent. I'd survived the 1929 crash with a $100 million profit because I preserved capital during the preceding mania. While others leveraged themselves to oblivion, I maintained reserves. Let me be absolutely clear. No position should ever risk more than 10% of your trading capital. I've never met a successful trader who consistently risks more. When I violated this rule myself, disaster always followed. In 1934, I ignored my own wisdom and overextended in cotton. The market punished my arrogance swiftly, taking 50% of my capital in weeks. Here's my method. I divide my capital into 10 equal portions. Each trade gets one portion maximum. If a position moves against me beyond my predetermined exit point, I close it immediately. No exceptions, no emotional overrides. The mathematics are irrefutable. Lose 50%, and you need a 100% gain just to break even. Lose 90%, and you need a 900% gain. Those are suicidal odds. I've watched countless brilliant traders destroy themselves by ignoring this principle. They make spectacular gains, become overconfident, then risk everything on a sure thing. The market has no memory and no mercy. It will take everything you have if you let it. During market panics, which I've lived through more than most, cash becomes the ultimate position of strength. In 1936, while others were forced to liquidate at devastating losses, I had dry powder ready. This allowed me to acquire prime positions at fire sale prices. Remember this: trading opportunities are infinite. Your capital is not. I've made my greatest fortunes not by capturing every move, but by preserving capital during uncertain times, then deploying it aggressively when the odds heavily favored my position. The traders who survive decades in these markets aren't necessarily the most brilliant. They're the ones who protect their capital religiously. I've seen mathematical geniuses go broke, and humble capital preservers build dynasties. The difference wasn't intelligence, it was discipline around this single principle. My final testament isn't what you'd expect. It's not about my greatest trades or how I made millions. It's about what I learned too late. In November 1940, sitting in my suite at the Sherry Netherland Hotel, I reflected on a lifetime of trading. The markets had given and taken away fortunes from me 4 times over. I'd climbed to the pinnacle of Wall Street success repeatedly, only to fall back to nothing. That evening, I wrote my final trading insights, truths I wish I'd understood decades earlier. The paper never saw publication. Hours later, I walked into the hotel's cloakroom and ended my life. But the wisdom I captured that night might save you from my fate. First, understand that no trading system, not even mine, works forever. Markets evolve. The patterns I exploited in the 1907 panic became less effective by the 1920s. My failure to adapt cost me dearly. When your proven methods stop working, don't double down. Step back and reassess. The market is telling you something has fundamentally changed. Second, isolation is a trader's silent killer. As my wealth grew, I withdrew from genuine human connection. I surrounded myself with sycophants rather than honest critics. In that echo chamber, my judgment deteriorated. Find trading colleagues who will challenge your thinking. My greatest losses came when nobody questioned my convictions. Third, psychological capital matters more than financial capital. By 1940, I had rebuilt my fortune to over $5 million, yet I was bankrupt in spirit. I'd lost the emotional resilience to weather setbacks. Guard your confidence like your most precious asset. Once it's gone, no amount of money can bring it back. Fourth, success creates its own blindness. After my triumph shorting the 1929 crash, I believed my own legend. This hubris led me to ignore my own trading rules. Remember, yesterday's victory often sows tomorrow's defeat. Stay humble, or the market will humble you. Fifth, the game is longer than you think. I traded for immediate gains rather than sustainable wealth. Had I managed risk more conservatively, my fortune would have compounded beyond imagination. The truly wealthy build systems that last decades, not trades that last days. My final insight: trading is not worth your life. I sacrificed everything, family, friendships, health, at the altar of the market. The millions I made couldn't fill what I had lost. The market will be there tomorrow. Make sure you're there, too, with your humanity intact. These lessons cost me everything. They're written in my blood. Heed them, and perhaps you'll achieve what always eluded me. Not just wealth, but the wisdom to keep it, and the life worth living alongside it. Now it's time to apply my principles to today's markets. I've walked you through my methods, my successes, and my catastrophic failures. The question is, what will you do with this knowledge in the modern trading landscape? First, recognize that while technology has transformed how we trade, human nature remains unchanged. The fear and greed that drove the panics of 1907 and 1929 are the same emotions driving today's flash crashes and meme stock frenzies. I would approach today's algorithmic trading environment with the same discipline I applied a century ago. I'd adapt my pivot point theory to modern charting software. With today's tools, identifying those crucial turning points is easier, but the discipline to act on them remains just as difficult. When I see a stock breaking through resistance on increasing volume, I still hear the market shouting its intention. The language hasn't changed, only the medium. In your trading, remember my cardinal rule: cut your losses quickly. I've watched new generations of traders repeat my early mistakes, letting small losses grow into account killers. The market doesn't forgive this sin any more today than it did in my time. The proliferation of options trading would intrigue me. Options provide leverage without the dangers of margin, something I learned about the hard way. But I'd approach them with the same caution I applied to any leveraged position. The instrument changes, the principles don't. Social media presents both opportunity and danger. I'd use it to gauge sentiment, much as I once used ticker tape behavior and newspaper headlines, but I'd be wary of the echo chambers it creates. The crowd is rarely right at major turning points. This truth transcends centuries. I'd still focus on liquid markets. Cryptocurrency might interest me, but only the established coins with sufficient volume. Liquidity was my sanctuary during market storms, and it would remain so today. Above all, I'd maintain my journal with religious devotion. In an age of endless information, documenting your own thought process becomes even more crucial. Your trading journal is the one source of market wisdom perfectly tailored to your psychology. The tools at your disposal far exceed what I could have imagined. Use them, but don't let them use you. Technology should enhance your discipline, not replace it. The market will test your emotional fortitude just as severely as it tested mine. Remember, the game remains the same. Only the players and the stadium have changed. Apply my principles with discipline, and you may avoid repeating my most costly mistakes.